to The Debate. It is Sunday, January 18, 2026. We are sitting at a fascinating and, frankly, a somewhat confusing juncture in financial history. If you open a newspaper, digital or otherwise, you're seeing blockades in South America, missile strikes in Europe, trade wars looming. I mean, by all accounts, the geopolitical world looks like it's catching fire. But if you close the paper and open your trading terminal, the financial system is the calmest it has been in years.
It's a divergence that makes you question your sanity, doesn't it?
It really does. We are witnessing this historic split between geopolitical reality and market pricing. So the central question we are tackling today is this. Is this profound low volatility regime, this, sea of green on the screens, is it a sign of genuine systemic resilience? Have we actually achieved the elusive soft landing? Or is this dangerous complacency? Is the market a coiled spring masked by structural mechanics, just waiting to snap?
It is the question of the year. Maybe the decade.
Okay, so I'm going to be arguing for the resilience thesis. I believe the data, the hard data, it confirms that central banks, specifically the Bank of England and the ECB, have successfully transitioned us to a stable, neutral policy environment. The silence in the VIX and the tightness of credit spreads. They aren't ignorance. They are a reflection of strong fundamentals. The system is working.
And I respectfully am taking the fragility thesis. I believe this calm is artificial, manufactured by market structure, specifically the massive options expiration we just passed on Friday, and a temporary blindness to deep structural risks. We are ignoring the slowdown in China and the breakdown of traditional asset correlations. The silence in the VIX, it isn't a comfort to me. It's the eye of the storm.
Well, let's get right into the machinery of this. My case for resilience is built on the fact that the low volatility signals are not just isolated to one pocket of the market. They are overwhelming and broad-based. I was looking at the cross-asset regime engine this morning. For our listeners, this creates a probability score for what kind of market environment we are in. And right now, it is a sea of green.
It's almost too green, if you ask me. Like a painted lawn.
But look at the breadth. Core equity, that's the S&P 500 and the NASDAQ 100, is in a low vol regime with probability scores well above 90%. But it's not just stocks. Rates, specifically treasuries, are in a low vol regime. Corporate credit is in a low vol regime. I mean, when every cylinder of the engine is firing smoothly and showing low stress, you can't just dismiss it as a fluke. The market is screaming stability.
Probabilities are useful, sure, but they can be backward-looking. They tell you what the weather was yesterday. They don't necessarily tell you a hurricane is forming offshore.
Then let's look at the turbulence. Right now, I track the system turbulence score, technically the Mahalanobis distance.
Let's maybe break that down for the listeners quickly.
Right, so think of the Mahalanobis distance as a seismograph for the financial markets. It doesn't just measure if prices are going up or down. It measures how weird the current price action is compared to history. It measures the strangeness of the relationships between assets. As of January 16, that score has dropped to 1.24.
Which is incredibly low.
It's subterranean. For context, the danger zone, that 90th percentile threshold where things usually break, is 3.63. We are miles away from that. We are sitting at a turbulence level that suggests the system is functioning exactly as it should. The S&P 500 is trading near record highs around 7,000, not because investors are blind to the headlines, but because the underlying economy has proven it can shrug off isolated geopolitical events. The market has rationally priced these risks and found them contained.
I see why you take comfort in the aggregates. The turbulence score is low, I grant you that. But I come at it from a different angle. Low vol does not mean no risk. In fact, in modern markets, prolonged low volatility often creates risk. It invites leverage.
The classic Minsky moment argument.
Precisely. But let's look at the mechanics. Why is volatility so low right now? We just passed the January 16 monthly options expiration. Leading up to Friday, we had massive amounts of option selling. When dealers are on the other side of that trade, they have to hedge in a way that suppresses movement. Think of it like a magnet holding a piece of metal in place.
Gamma penning.
Exactly. It pins the market. If you look at the 10-day realized volatility on the S&P, it was crushed down to about 8%, a historic trough. That isn't organic stability, my friend. That is mechanical suppression. It's like holding a beach ball underwater. Now that those contracts have rolled off as of Friday, the magnets are gone. The hand holding the ball down is removed.
Mechanical suppression or not, the price auction has held. If the fear was real, the floor would have fallen out the moment the options expired. We haven't seen a flush.
Give it a few days. The liquidity needs to thin out first. But look at where the signal isn't green. You mentioned the sea of green in the regime engine, but you skipped over one glaring red light: gold. Gold is explicitly in a high volatility regime with a 76.4% probability.
Gold has always been idiosyncratic. It beats to its own drum.
Gold is the canary in the coal mine. While equities are asleep at the wheel, gold is sniffing out something systemic. It's pricing in currency debasement and geopolitical stress that the S&P is ignoring. And structurally, look at the macro backdrop. China's service PMI just dropped to a 6-month low of 52.0. Their GDP forecasts for 2026 are falling to 4.5%. You have the second largest economy in the world sputtering, and the S&P 500 is pretending everything is fine. That's not resilience, that's a disconnect.
I want to push back on the China narrative because I think the market is actually interpreting that correctly, even if it sounds counterintuitive. But before we go there, we have to talk about the central banks, because ultimately they set the gravity for asset prices.
Or they try to. Sometimes gravity fights back.
And I'd argue they are succeeding. We spent all of 2024 and 2025 waiting for the lagged effects of tightening to break something. The recession that was 6 months away for 2 years never happened. Look at the Bank of England's decision on December 18. They cut rates by 25 basis points to 3.75%.
A very controversial cut, mind you.
But a cut nonetheless. Governor Bailey is now expecting inflation to hit the 2% target by May of this year. That is a victory lap. And across the channel, the ECB held steady, but they upgraded their growth forecasts. They're seeing resilience in the euro area economy. We are shifting into a neutral regime, where monetary policy stops being a headwind. That removes the biggest source of volatility we faced for 3 years. The adults are back in charge, and they've stuck the landing.
I'm sorry, but I just don't buy the victory narrative. It feels premature, almost arrogant. You look at that Bank of England vote, and it was a narrow 5-4 split. That is not a consensus. That is a board that is deeply divided. Almost half the room thought cutting was a mistake. Members are warning that future cuts are closer calls.
But the direction of travel is clear.
Is it? The market priced that split immediately. Sterling jumped, yields jumped. This implies the easing cycle might be over before it really started. If inflation proves sticky, they are stuck.
A 5-4 vote for cut is still a cut. It signals that the emergency phase is over.
But you cannot view Europe or the UK in a vacuum. You have to look at the global engine, which brings us back to China. You brushed past the data earlier, but think about the trade balance. China posted a record $1.2 trillion trade surplus in 2025.
Which implies strong exports. That sounds like economic activity to me.
It implies dead domestic demand. The Chinese consumer isn't buying, so Beijing is forcing those goods onto the global market at rock-bottom prices. They are exporting their way out of a slowdown. That means they are exporting deflation to us.
Which arguably helps the ECB and the BOE hit those inflation targets you're so skeptical of. Cheap Chinese goods keep our CPI down. That supports the soft landing thesis.
Short term, yes, it's a sugar high. But look at the reaction. U.S. tariffs are looming, and the trade war rhetoric is ramping up in Europe too. That export engine is at massive risk. If China slows further, and 4.5% GDP is optimistic if a trade war hits, then the neutral stance in Europe won't be enough. You're celebrating a pause in tightening while the global demand picture is evaporating. The ECB is upgrading growth forecasts based on an export environment that might not exist in 3 months.
I think you're underestimating the domestic strength in the U.S. and Europe, specifically services. The consumer in the West has money. But let's pivot to the elephant in the room, the world on fire narrative. We started this by mentioning the headlines. We have a U.S. blockade of Venezuelan oil that started mid-December. We had missile strikes in Ukraine over the holidays.
Significant escalations.
And yet, where is Brent crude?
It's trading around $60 a barrel. If these were a systemic threats to the global energy supply, oil would be at $80, $90, maybe $100. The market is effectively telling us these are localized issues. I look at the composite stress index, and it's actually negative, at negative 0.42. Financial conditions are loose. The market has had a month to panic about Venezuela and Ukraine, and it has chosen not to. That is the definition of resilience.
Or it's the definition of mispricing. I think the oil market is completely misreading the supply shock because it's overly focused on the demand weakness we just discussed regarding China. It's seeing the weak demand and ignoring the supply cliff.
You think traders are just ignoring a naval blockade? These are sophisticated actors.
I think they are looking at the wrong data, or rather trusting laggy inventory data. The Venezuela blockade is real. Since mid-December, we track the tanker traffic. Only about 3 tankers have made it out. We are talking about flows dropping from 642,000 barrels per day to a trickle. There are only 5 million barrels en route to China right now. That supply chain has been severed.
But global inventory is sufficient to absorb that, at least for now. We aren't seeing lines at the gas station.
For now is the operative phrase. Chinese refiners stockpiled late last year, which is masking the shortage. It's like checking your bank account and feeling rich because you haven't paid the mortgage yet. When that inventory runs dry, and what if Beijing is forced to stimulate to save that 4.5% GDP target, which I believe they will be?
Then demand spikes.
Exactly. Suddenly demand comes back online right when supply is structurally constrained by the U.S. Navy. That sends oil spiking. If oil breaks $70 or $80, suddenly your inflation is solved narrative for the BOE and ECB goes out the window.
So your fragility thesis relies on a perfect storm. China stimulating exactly when the blockade bites, creating an inflationary impulse that the central banks aren't ready for.
It's not a perfect storm. It's a likely sequence of events. I'm saying the risk is asymmetric. The market is pricing in perfection, and the markets are sniffing it out, just not the S&P. Look at the divergence in the last month. The S&P is flat to slightly up, but look at crypto. Bitcoin is up 8.1% in the last month. Gold is up 5.4%.
Speculative assets. Bitcoin goes up when the wind blows.
Assets that thrive on instability and debasement. They are diverging from equities. They are telling us that the low vol in stocks is a lie, and the instability is real. They are the pressure valve popping because the equity market is sealed shut.
I see the divergence, but I interpret it differently. Crypto and gold running up can be a sign of liquidity abundance, the loose financial conditions I mentioned. When money is cheap, people buy speculative assets. It's greed, not fear. If it were fear, genuine systemic fear, you would see it in the credit markets. And that brings me to my strongest point against your fragility thesis.
Let me guess. Credit spreads?
Exactly. You can fake a low VIX with option selling. You cannot fake corporate credit health. BBB spreads are at 0.97. Even junk bond spreads, CCCs, are at 8.56. These are levels indicative of a robust expansion. If companies were about to default, if there was a coiled spring of systemic risk, bond investors, who are notoriously pessimistic, would be demanding a higher premium. They aren't. They are lending freely.
That is a compelling argument, I admit. Credit usually leads equities, and right now, credit is relaxed. But have you considered the market structure beneath those spreads? We are seeing a breakdown in the correlations that hold the whole portfolio construction model together. I was looking at the correlation term structure this morning. This is the stuff that keeps risk managers up at night.
What specifically? The relationship between stocks and bonds?
Precisely. The entire 60/40 portfolio, the entire risk parity industry relies on the idea that when stocks fall, bonds go up. They are supposed to be the shock absorbers. On a one-year basis, the correlation is still negative, negative 0.30. So looking back a year, the hedge works.
So the system is safe. The shock absorbers are there.
Look closer. Look at the one-month window. The correlation between equities and bonds has spiked to positive 0.91.
0.91. That's extremely high.
Positive 0.91. That is effectively 1. They are moving in lockstep. This is the nightmare scenario. If we get that volatility spike, maybe from the oil shock, maybe from the Supreme Court ruling on tariffs later this month,
And stocks sell off, bonds are going to sell off with them. Yields rise, stocks fall. There is no diversification. The safety net is gone.
That one-month spike is an anomaly driven by the rate repricing in December. It's noise in the data. You can't throw out 50 years of portfolio theory based on 4 weeks of trading behavior.
It's noise until it destroys a risk parity portfolio. You have a 0.91 correlation right as the volatility suppression from OPEX rolls off. It's like driving a car where the brake pedal is suddenly wired to the accelerator. And speaking of the VIX, you cite it at 15.8 as a sign of calm. I look at the spread between the VIX and the GARCH, the realized volatility model.
And what does that spread tell us?
It's narrowing. We are seeing the gap between implied safety and realized risk close. With the S&P at 7,000, liquidity is thin. If we get a mean reversion in volatility triggered by the Fed's January 27 meeting, perhaps, it won't be a gentle slide. It will be an air pocket. The structure isn't robust, it's brittle.
I think you're seeing monsters in the shadows. A positive correlation for 1 month does not negate a decade of structural relationships. Disease score for the yield curve systemic stress is positive 0.65. The curve is behaving normally. You're focused on the edge cases, the Venezuelan tankers, the 1-month correlation blip. I'm looking at the core machinery, corporate earnings, credit solvency, and central bank competence. The machinery is humming.
The machinery hummed in 2007 too, right before the credit markets froze. You're trusting the lag. I'm looking at the leading indicators.
We're winding up against time, so let's try to synthesize this for the listeners. It seems we are looking at the exact same world through 2 very different lenses. From my perspective, the low vol regime is supported by the hard data. System turbulence is at 1.24, historically low. We have competent central bank management evidenced by the BOE cuts and ECB stability. Corporate credit is resilient. The soft landing isn't a hope anymore, it has been achieved. Investors should trust the regime's signals. Green means go.
And I conclude that the data looks backward, not forward. The low vol signal is a mirage created by options positioning that expired 2 days ago. The reality is in the short-term correlation spike of 0.91, the high vol signal in gold, and the physical reality of a blockade on oil supply that hasn't hit price yet. We are in the eye of the storm. The calmness is the danger.
The divergence between data calm and real-world chaos really is the defining story of early 2026. It's rare to see the lines drawn this clearly.
It is. And for our listeners who are trying to figure out which one of us is right, don't just watch the S&P. The tiebreaker is going to be Brent crude and the Chinese stimulus response. Watch those too. If oil breaks $70 or China announces a major fiscal package, the low vol regime ends fast.
Or oil stays at 60 because the world has changed, and the S&P climbs to 7,100. We shall see. Thank you for listening to The Debate.
Thanks for having me.